Hi there, friends. Welcome to my weekly newsletter for the week of May 22nd. Glad you could be with us. This past week, interest rates ticked higher in response to the still unresolved debt ceiling debate. Let's look at what happened and discuss the events to watch for in the coming week. Debt ceiling fallout. At this time, there is no resolution to the debt ceiling debate where Congress and the White House agree on a plan to lift our spending limit. In the absence of lifting our debt ceiling, there is a risk of debt default and/or credit downgrade. Any of those scenarios would be very disruptive to financial markets and our overall economy. We are already seeing upward pressure on rates due to the lack of a resolution. The one-month Treasury bill spiked to 5.6%, up from 4% just a few weeks ago. This dramatic spike has also placed upward pressure on the 10-year Treasury yield, as well as mortgage rates, ending the week at two-month highs. There's optimism a deal will get done, but until that happens, we should expect continued upward pressure on rates, along with a lot of volatility. Regional banks faring better. Some good news in the banking sector. A couple of banks which were feared to have had problems reported larger than expected deposits over the first quarter. This gave a sense that the worst of the banking crisis may be behind us. It may still be too early to tell, but stocks blasted off Wednesday from this optimism, with the S&P touching 4,200 for the first time since August of last year. However, if we see the banking sector stabilize, it may embolden the Federal Reserve to continue holding rates higher for longer. The Fed echo chamber. Federal Reserve officials were out speaking tough this past week, offering their thoughts on rates and inflation, mostly noting the need to keep rates higher for longer. Some, like Fed Governor Philip Jefferson, offered hope for a June pause on hikes, saying, "History shows that monetary policy works with long and variable lags, and that a year is not long enough of a period of time for demand to feel the full effects of higher interest rates." We shall see. 33% for a quarter point. Those are the current odds. Despite high uncertainty around the debt ceiling debate and banking sector, the chance of a quarter point rate hike in June has jumped to 33% from nearly zip last week. Remember, Fed rate hikes have no direct impact on home loan rates, but this will affect credit cards, auto loans, and home equity lines of credit. Mixed messages. Conflicting signals on the health of the consumer is adding to the uncertainty in financial markets and what the Fed may do next. Retail sales for April came in less than expectations when factoring in inflation, and Home Depot's earnings report was quite poor. Yet the very next day, Walmart reported fantastic earnings, highlighted by a broad range of purchases by its consumers. Reports like this elevate fears of more rate hikes ahead. Bottom line is the debt ceiling debate continues unresolved. We should not expect much, if any, improvement in interest rates. Now, looking to the week ahead. The debt ceiling debate remains the most important event to follow. As this continues unresolved, we should not expect much, if any, improvement in interest rates. And if that were not enough, the Fed's favorite gauge of inflation, the Core Consumption Expenditure Index, or PCE, will be released on Friday. If this number comes in soft and the debt ceiling issue gets resolved, we could see rates make a nice move to the better. Now to the charts. All right, now looking at the Fannie Mae 5.5% coupon, this is where current mortgages are being packaged and sold off after closing. Reminder, red days are bad, green days are good. We want to see bond prices move up. They have an inverse relationship to yield. And so as bond prices move up, yields or rates move down. You can see that we've lost the battle against the 200-day moving average, which again continues to be a strong, formidable line in the sand that we must cross before interest rates can make any real improvement going forward. The debt ceiling debacle debate, as well as the increased chance for a Fed rate hike in June, is pushing rates to a level we haven't seen since the beginning of March, so a little over 2 months. Looking to the yield of the 10-year Treasury, not price, this is yield. This will show the pronounced move in interest rates over the past several sessions, pushing up to a level, again, not seen since the early second week of March. Well, I appreciate you spending a little time with me here today. Hope this is valuable to you. Feel free to share, like, provide any comments, shoot me a text or email if I can be of any assistance. Thank you and enjoy your week.